the struggle that's happening right now are people have bought deals from 2020, 2021, 22 at prices that, are difficult to make sense in this current environment. And I think a lot of people and a lot of deals we're seeing, people are having struggles refinancing out of their existing loans.
I know even my own personal property, it is up for renewal next month. And I had a 2% mortgage 5 years ago. People got kind of spoiled.
I started investing in real estate from my first single family home in Philadelphia. My first property I bought in 2016. It was a 2-bed, 1-bath in Philly called Grace Ferry. I bought it for $25,000. I put 25 into it and refied for $125. I pulled 100,000 out, and all of a sudden I'd made all this tax-free money, and I was like, hey, let me do this 12 more times.
I find it fascinating for me that you're in what I'll call pure financial, and yet you were through you mentioned the recession. We're talking about 07, 08, and yet you chose to go into real estate shortly after. Was there anything that you saw during that really stressful time period that kind of pushed you more towards real estate?
The same reason I bought Bank of America at $4 a share. I just thought that if the entire financial system falls apart, this would have been a bad investment. But if the entire financial system falls apart, the US dollar is not worth anything anyway. So what's the difference? I might as well own something I can move into. That was kind of my perspective. The whole point of the government providing these subsidies on interest rates is to be able to support housing for the people who need it the most. We get that advantage in our interest rate and some of the terms that we get.
What were you guys seeing 5 years ago? I think you said 5.5% compared to residential isn't quote unquote that bad.
Yeah, at the absolute lows, we were securing mortgages in the high.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Michael, you worked at JP Morgan and Merrill. In this current climate that we're in, which isn't that great, like right now, what's the number one look-safe assumption in multifamily that's hurting a lot of investors? Rent growth, expenses, or debt?
Well, I think the thing that's hurting people the most right now is probably just the level of absolute interest rates relative to where they purchased and where rates were at that time. So, I would say that the struggle that's happening right now are people have bought deals from 2020, 2021, 22 at prices that, are difficult to make sense in this current environment. And I think a lot of people and a lot of deals we're seeing, people are having struggles refinancing out of their existing loans. Even if there is equity there, there's just not quite enough to, cleanly refi. So that's what I'm seeing right now.
So as my audience knows, I'm a single family, mainly residential guy. I have my own multifamily portfolios and things like that, but my property management company focuses on single family. And I know even my own personal property, it is up for renewal next month. And I had a 2% mortgage 5 years ago. I think people got kind of spoiled. Obviously I'm up here in Canada. Mm-hmm. What kind of interest rates are you seeing in the multifamily space?
So in the multifamily space, we, are lucky that we get subsidized by the U.S. government because it is sort of a core need. So these aren't going to apply to some other commercial real estate asset classes. But typically we're seeing whatever the 5-year treasury, 10-year treasury, so whatever your reference rate is, and usually about 130 to 170 basis points over that. So what that means today is about a 5-year loan, I'm going to be in the low to mid 5s. So 5 to 5.5, something like that.
Yeah, that's about what we're at. Up here in Canada, we have CMHC, Canada Mortgage and Housing Corporation. Now you guys have similar insurance vehicles. And given that this is an educational podcast, I'll just explain. If you're able to get CMHC, and we have something up here called MLI Select. So that's sort of an energy program, low income housing, you get sort of points for whatever you do. Mm-hmm. Long story short, if you're able to get that insured, meaning the mortgage is insured by the government so that the lender feels more confident, then you get a bit better of an interest rate. Mm-hmm. Is that sort of the same thing that you're talking about?
They have programs typically called like the green program. And so you typically see a discount on that spread. Same for affordability. So it's a very much mission driven type of financing. So to the extent that you are, your residents are in the 60% to 100% of AMI. So they're, median income or lower for the area. The whole point of the government providing these subsidies on interest rates is to be able to support housing for the people who need it the most. So we get that advantage in our interest rate and some of the terms that we get, and that's different from the residential side where rates are for single family homeowners who want to buy a primary residence. They're probably in the 6 to 6.5 range. And then if you're a primary resident or excuse me, if it's a residential and it's for investment purposes, you're probably in the high sixes or low sevens, which is a quite a high rate and difficult to make numbers work, at that level. For
But what were you guys seeing 5 years ago? Because you're expressing, I think you said low five, 5.5%, which compared to residential isn't quote unquote that bad. I mean,
Mhm.
it's not great compared to what we're used to. What were you seeing 5 years ago?
Yeah, I mean, at the absolute lows, we were securing mortgages in the high twos, or in the threes. So, and that's really the only way people were getting deals done because cap rates were at 3.5 to 4.5. So people
Oh
were
wow.
arguing, oh, well, I could get positive leverage because, if I'm going to buy a four cap, that's okay because my interest rate's a three. Of course, that wasn't the long-term rate of interest. That was just the short-term rate of interest, and that quickly reset after that brief period of time that cap rates went down.
Yeah, before we get into too much, because I feel myself wanting to get into the weeds here on cap rates and
Sure.
interest rates. Why don't we back up? Tell the audience a little bit about yourself, and give us a bit of a background.
Sure. Yeah. So I'm a partner, a founder, and CIO, I guess, co-founder, I should say, of Carbon Residential. We're a vertically integrated private equity firm. We focus on providing safe, clean, affordable housing for middle-income Americans, primarily in growing areas throughout the Southeast. And that typically is a older property, 100 to 300 unit type garden style apartment with a pool house. But we're looking at 8 foot products, so these are 70s built, 80s built, so maybe early 90s, and really buying them for long term hold. So if I could, I'd hold them and I never sell them. And I can't always get investors to agree to that. And then otherwise, my background. So that's what I do now. I started my career in finance. Worked for, as you had mentioned, JP Morgan, Merrill Lynch, primarily on the fixed income desk, trading securities, helping ultra high net worth and small foundations and endowments with their fixed income portfolios. And I've also done quite a bit of financial consulting, workouts, bankruptcies, combinations, buyouts, that sort of thing.
So, I mean, when you were a young person, and people asked you, what did you want to be when you grew up? Did you think you'd land at Morgan and Merrill?
Yeah, I think originally I was thinking I would go into M&A and I would do more investment banking than investment management. But I just enjoy investment management more than investment banking, and that's just the the way that my career went. But very similar, just buying and improving assets or companies. It's similar dynamics, similar fundamentals.
When you talk about, because this is not my space, like you're on a fixed income type of, I don't know if you call it a portfolio. What exactly would that be?
Yeah, so just really the bond side of
Okay.
like a allocation. So if a typical client would come to us, we would work with clients typically that were having portfolios from 50 million to say 2 billion, and they would come in and we would be responsible for looking at their existing bond portfolio, looking for ways to optimize it, whether that be to maximize yield, to match a duration mandate. All of these institutions and larger family offices have a very specific mandate that they have to stick to. Investment policy statement is what it's typically called. And so that will govern a lot of times what type of risk that you can take, what type of securities you can hold, what kind of quality you can have, what the maturity range would be of those securities. And so our responsibility would be to bring those assets in, try to figure out what their existing book look like, look at their mandate, and then rejigger that portfolio to maximize either yield or minimize risk or whatever made the most sense for them based on those constraints and their goals, and obviously what we were doing with the other part of the book, whether it was the public equities, private equity, all the other kind of food groups that are available, that other groups inside of the firm would deal with. So yeah.
Okay. So, um, Investing to Win started off as a real estate podcast, then morphed into more of a business podcast. And I really like digging into sort of the origin stories of entrepreneurs. And I think that's what my listeners enjoy. So, can you mind indulging me for a couple of minutes? Walk me through, the bond side. I get that you're in investments, but why real estate? Like, how did that transition happen in your mind?
Sure. Yeah. So my family has been in real estate for some time. So I guess the line would be that I'm fourth generation real estate entrepreneur. So my family's been,
Fourth generation,
yeah,
really?
yeah. So since yeah, my post World War II and on, that and everyone in my family, not everybody, but a line on each side of the family was involved in real estate in some capacity, whether it was single family homes or, other types of commercial property and things like that. So I grew up around it. It was sort of quote unquote kind of the family business. And when I was a teenager, I worked for my father, digging holes, grading land, working essentially as a day laborer. I was much worse at the job than the other people, and I worked way
How many times
slower.
did you get fired, Michael? Come on, you got to
Luckily, I
tell
didn't get
us.
fired, but it was one of the best paying jobs I ever had relative to my ability. Uh, and but it was backbreaking work, and it was up very early in the morning to drive to the job site before the sun, and so good character building, I guess. I think that's what my father would say because it was his job sites. But I learned that way what construction looked like and how to go from a piece of dirt to a completed home, and I realized from that effort that I didn't want to do that. That I wanted to go into finance. That's what I thought at that time was the thing to do. And or at least in my head, it was I was good with numbers, and it seemed like there were a lot of great movies that caught my eye. I was like, oh, I want to be a banker or some kind of an investment type person. So I went ahead and pursued that career and worked really hard to do that. And I was at the point where I guess we were sitting in the mid 2010s, and I had essentially achieved what I was on the path, right? I was in the department I wanted to be in. I had gone through the JP Morgan analyst program at the height of the recession. So there's very limited people who were actually in, alongside that, which also meant there was a little bit less competition, because there weren't as many people that I had to fight against to win the coveted seats of portfolio manager or whatever that was available. And then I realized, I was at that point, I was commuting 2 hours each way from Princeton to New York, taking a car to a train to two subways to Midtown. And, after doing that for a long time, and thinking about starting a family and what my life was going to look like, didn't seem like that was going to be the right move. And that's what had me start thinking about, okay, well, what could I do to start thinking about, not trading time for money, but doing work that would then pay me forever. And so that's how I started investing in real estate, from my first single family home in Philadelphia. My first property I bought in 2016, August 15th of 2016, actually. It was a 2-bed, 1-bath in a little area of Philly called Grays Ferry, and in the path of progress. I bought it for 25 grand. I put 25 into it, and
Love it.
it refied for a buck 25. I pulled 100,000 out, and all of a sudden I'd made all this tax-free money, and I was off to I was like, hey, let me do this 12 more times. And, certainly a lot of lessons were learned throughout that journey, but that's how I kind of started. And then, since then I've done, a lot more projects.
Yeah, I find it fascinating for me that you're in like what I'll call pure financial. Okay. for pure financial investment. And yet you were through the, you mentioned the recession. We're talking about, '07, '08.
Mm-hmm.
And yet you chose to go into real estate shortly after. Or
Mm-hmm.
were there was there anything that you saw during that really stressful time period that kind of pushed you more towards real estate? Because some people would say, I'm not going to go into real estate. I see people turning in their keys.
Yeah. Well, luckily during the '08 crisis, I was still in high school. So I graduated. Well, no, I graduated high school in '07. Was lucky enough to go to college during
Yeah.
that time from 7 to 11, and so we were
Okay.
just starting to come out of that. And then I was in financial services. You know, I didn't. Although I started investing in real estate in 2016, I didn't leave my W-2 until 2018 or 19. So I
Okay.
was doing that along the side until I could develop enough cash flow to support our lifestyle. And so I just saw it as a great buying opportunity. And I think that I took that same approach
I see.
from finance. The same reason I bought Bank of America at $4 a share. I just thought that, I guess if the entire financial system falls apart, this would have been a bad investment. But if the entire financial system falls apart, the US dollar is not worth anything anyway. So what's the difference? I might as well own something I can move into than otherwise. And so that was kind of my perspective. I figured I couldn't get any worse. And if it got any worse,
Yeah.
I had bigger problems on my hands than losing the money in that house, in that first
It's
property.
interesting you say that. That's the main reason I chose to start my investment journey in real estate. And my audience knows, you might not. Like I bought my first rental property at 27, and I built that up into 75 doors, all singles,
Mm-hmm.
all singles and duplexes,
Mm-hmm.
43 buildings over 10 years, all while working a full-time job.
Mm-hmm.
And I knew in my head, well, I started in 97, so that was just after another readjustment there, that if everything hits the fan, at least I can go to the building, I can see it, touch it, smell it, whatever,
Mm-hmm.
right? I mean, that's kind of what it is. If I can't, if it's empty, I can always get a job and pay the mortgages. Of course, I never had to do that, because if you do it right, you learn through trial and error. So let's go back, because we're starting to go down a bit of a side path there. Thank you for the intro. I mean, it's really obviously a lot of experience that you have. We'll talk about carbon in a couple minutes. We were talking about interest rates. That's what we started the pod with. And so I remember back about 4 or 5 years ago, because my family, we just sold, actually divested a 3-story walk-up 22-unit apartment block. So not as large as the garden style that you're talking about, but still, we were talking like, 2.9, 3.1, 3.4
Mm-hmm.
over the last 5, 10, 15 years, because it was government insured. What does the financial cash flow picture look like going from a 3.1 or a 3% up to a 5? Like, the uninitiated would say, well, it's only 2%. What's the big deal? You guys have lots of cash. It's multifamily.
Mm-hmm.
Speak to that uninitiated person who's listening right now.
Well, it sort of depends a little bit about the basis, because if you have depending on your basis that and the amount of cash flow and earnings that you're generating, a move from a 3% mortgage to a 5% may not matter much at all. But I think what was happening were people were buying at a very high valuation, meaning that the NOI or the earnings that they were getting were pretty low. And so,
Well, you're talking cap rates in the three. Did I hear
yeah,
you
in the
say threes and
threes. Yeah, we
fours?
were
Like,
seeing cap
wow.
rates for sure in the threes. So, if you were looking at, and people were also leveraging to the hilt. So you were taking out a
Yep.
lot of leverage, and maybe you were generating a 4% yield on the asset and you were paying 3% to your debt holder. And so that math was working out okay. You were having some positive carry, and you were going to grow that NOI, right? So the whole story was, hey, I'm going in at a 4, but I'm going to get it to a 6 or a 6.5. And if I'm financed at a 3 and I'm going to get it to a 6.5, that's going to look pretty good, right? And we could go through I mean, we could do some numbers if you want, but basically that would be a pretty decent spread, 200, 300 basis points in between the financing rate and the cap rate. And so, but that's obviously not what happened, right? So what ended up happening is that maybe they executed the value add, maybe they got to a 6, but unfortunately cap rates moved up to about a 6. And then interest rates moved up almost to a 6. And so to be able to refinance out, you might still be generating positive cash flow there because you still have some positive leverage and you're maybe eking by a little bit because you don't have to pay. You obviously only pay that interest rate on the debt. You don't pay it on the full asset. You're earning 6% on the full asset, and then you're paying 5% on the debt. You're still a positive carry. The problem is that you can't refinance into a new loan and cover the debt service coverage ratio you need to based on a little bit more stricter standards that people have today. And so that's really the issue. Also with bridge debt, which is how a lot of people were doing these deals,
Mm-hmm.
you know, the cap rates are a little funky and the underwriting's a little bit, projection-y based, even on the expenses. So what might seem like was a good deal on paper when you got the financing, 6 months later, your expenses are 20% higher than you thought. Your revenues aren't quite as high as you thought. And now all of a sudden rates have gone up, values have gone down. And you're sitting there saying, hey, I've got a $20 million loan and a $21 million property. I can only get a $16 million loan. I got a $4 million gap. What am I going to do? And so now what we're seeing is a lot of people are just trying to sell and recover and just pay off their note, right? Just get out of the deal, pay off their note because a lot of that equity is just gone.
I've had, I mean, like I said, the podcast has expanded. I've had crypto people on. I've had an insurance guy last week. But I do love talking about real estate. I had somebody on a few weeks ago, which will be released in a couple of months. But to my point, I'm hesitating because I don't want to insult anybody, but a lot of, I'll call them junior syndicators, okay?
Sure.
Will take a course through some guru and start raising money. And maybe they're very personable and they hold webinars and they get all these things together and they, never mind the asset itself, but a typical, GPLP type structure. Are those the types of groups that you're seeing that are selling right now because either they didn't structure the deal properly or they didn't promise the right type of thing to their investors? Like you mentioned, if your investors agreed, you'd hold everything forever.
Mm-hmm.
Are you seeing those assets right now, or is there another reason that people are selling?
Yeah, I mean, I would certainly say there's a fair bit of people who got over their skis in experience first cycle, and they came up post financial crisis, had maybe a great knack for marketing and were able to raise a lot of capital in a high liquidity environment, right, where the government was printing money. Every asset was worth way more than it was yesterday. And so that money had to go somewhere. And the Fed was just printing, and it was obvious they were printing, and they were easing as well. So they were printing money, and they were, so everyone was sort of go for it, right? And so I think people just sort of were like, hey, I'm going to secure the bag a little bit. And they went for it, not really thinking about what the consequences would be if real estate didn't perform well. And I think a lot of the education perhaps in the space is, real estate never loses money. And that's, over over a 10 or 20 year rolling basis, that's true. Yeah. But over a 5-year rolling basis or a 3-year rolling basis, that's not true at all. And because it's a liquid and because you have a real, it's a carry trade, you've got to be able to cover the costs. If you can't hold on, it doesn't matter about the 10, 20-year rolling returns. Those are irrelevant because you really need to be focused on the 36 months. So there was maybe a little bit lack of perspective. I think there were people who maybe didn't have a lot to risk. It was really an option for them, value, sort of like, hey, if this works out, I'm going to make millions of dollars, right? That's kind of the give and take with the from the sponsor's perspective. It's not a good incentive that this, that environment creates, but because of the environment that we were in, you had a lot of people who could raise a bunch of money in 100 days, maybe raise $15 million, buy a $50 million property, pocket $1 million fee at that time, and then
Mm.
make what they think is going to be $5 million on that single deal. And instead, some of those people made money, but a lot of them just kept doubling down all the way up to the peak, right? And then they get stuck in the peak, paying the highest prices, and being in the worst possible position. So yes, I would say that we definitely are seeing a lot of opportunity because of that, but it's not 100% just inexperienced sponsors. I would say that there are a lot of sponsors who bought with agency financing and they weren't able to execute the value add. And as a result, because values went down 20-25%, that's tough math, right? So even if you did everything, even if you bought at a reasonable level and you were relatively conservatively levered, if you didn't execute the value add that you anticipated, it's still quite hard. So yeah, I mean, it's been a challenging environment for a lot.
Yeah, no, it definitely has. It definitely has. Tell me a little bit more about carbon.
Sure.
What is it made of? What are your sort of, I guess, your investment thesis,
Mhm.
for lack of a better word?
Yeah. So we have a pretty robust framework for how we evaluate opportunities, but I would say we're really focused on margin of safety. And obviously I didn't make that term up. Benjamin Graham made it up, I guess, or, but maybe someone before him. And so, what that looks like to us is we want to be in really fantastic locations, which we dictate based on schools. So it all starts for us by looking at the school
Mm.
district, and because we really cater to families. So we're looking for families with school age children, which means we're likely looking for properties with more 2s and 3 bedrooms versus 1 bedroom versus studios. I don't really like studios at all. I don't really like 1 bedrooms. I like them. I like my 2 bedrooms to have 2 bathrooms. I like my 3 bedrooms to have 2.5 baths. And so these are all things that we like because families like them. So we want to make sure our physical product matches the demographic or the desires of the family. We also want to be in a location, like I said, that is oriented to the best schools. So if you were to look at, we use a number of different sources, but if a lot of people know greatschools.com. So we're only looking for schools that are
Mm.
8s, 9s, or 10s, which are the top 10% or so in the state. And it's a relative scoring by state. So you can find 8s, 9s, and 10s in every state. They may not be exactly the same quality on an absolute basis, but we're looking for the best in that area. And then that typically, how those scores are arrived at typically means that the incomes are relatively high, house values are relatively high. That's how it's really all money is very important to how they get to have good schools. So we're typically seeing $80,000 to $110,000 income areas. We're typically seeing very low crime. We're typically looking at relatively established neighborhoods that are mostly owner occupied. So we're not looking for 50-60% renter occupied. We want to be at like 30% renter occupied, with the rest being owner occupied. Typically, the house values are 250, 300,000 to 500,000 or potentially higher. Which means that many of our tenants will not necessarily be able to afford a home ever. But they're going to want to stay in district. And so if we can find them, if we can give them a really quality product at the right price, they'll stay for a very long time because they don't want to move out of district because their kids are in school. And we find that, people who are looking for those same areas share our values, and then they tend to take care of the property and build a community, which tends to lead to higher retention, lower R&M, better NOI, better cash flow. It's a big kind of
No, of course, yeah.
loop.
Not a lot of investors understand that part of it, like focusing on the tenant.
Mm-hmm.
You're actually going to give a compliment here. One of the first guests I've had who have actually spoken from the tenant's perspective. I had commercial people on here who talk about, okay, we're going to focus on this subclass in neighborhoods, anchor tenants like chiropractors, bricks and mortar. But yeah, no, I find it brilliant actually. And I'm saying that as a residential property manager for 30 years. Like we
Mm-hmm.
manage 600 doors up
Mm-hmm.
here, but they're all single family. And I find if you don't focus on the tenant, you're going to get that turnover, and you need to be able to attract them.
Mm-hmm.
Now, I 2 and 3 bedroom, I mean, that's not easy to find
Mm-hmm.
in multi.
Mm-hmm.
Are you finding that it's, I mean, how hard is it to find your assets,
Mm-hmm.
or were these built a lot in the 60s and 70s?
Yeah, so that's what ends up happening is that because we're older vintage, they weren't as concerned with optimizing, square footage and a lot of the, a lot of the current assets that are being built. They're trying to make everything smaller so they can fit in more units. In the older product, I don't have as much of a problem, and I can get an 1,100 square foot 3 bed without a problem. Whereas they probably would
Mm-hmm.
never do that today. They might try to get
Yeah.
that done in 900 square feet, and that's it's a tight. It's tight to be 3 bedrooms and 900 square feet, and you really got to kind of rejigger everything. And so we have the benefit of being an older vintage product, which is also a consequence of being in these neighborhoods that are older and established. There's really nowhere to build. So the supply issues that some folks have in these kind of greenfield areas where you can just keep pushing out, pushing out, pushing out. We don't really come into that problem because supply is there is no new supply. It doesn't exist. And if it is a new supply, it's like an $800,000 house, right? Maybe a builder
Right.
builds 6 houses for $800,000. Never going to be a comp to what we're doing.
No, again, it's brilliant, because if you're focusing, and I'm just, guessing here, but if you're focusing on the 60s and 70s, and you've got those 2 3 bedrooms, you mentioned, like, I think you said hopefully with pools and things like that,
Yeah. Mm-hmm. Yeah. Full
because that's
amenities, right? The
attracting,
dog
yeah,
parks, all
like
the same
kids,
stuff,
right?
you
Yeah.
know? Mm-hmm.
Yeah, it's going to attract families and have them stay around longer. And like you said, there's got to be a subset of stable tenants that are not going to, or can never really afford to go into a house. So therefore, you're providing almost like a community service by providing long-term housing.
Mm-hmm.
It seems to be really a win-win.
Yeah, I think so. And, if just to give a sense of rents, typically the rents in these areas, although the incomes are very high, we're talking about $1 a square foot, maybe $1.20 a square foot
Okay,
at the
very
maximum,
affordable.
right?
Yeah.
So, so you're talking $1,100 to $1,300 for a 2 or 3 bedroom apartment that's been totally renovated, typically, with hard stone in some cases, depending on the situation, but new
Hmm.
appliances, good new floors, nice property, just as much nice as any of the other ones. Maybe again, you're not going to get the higher ceilings. Your product overall is going to be older, but the different, some of this new product is going for $3-4 a square foot, and that's just not attainable for most people. And frankly, I think it's crazy. I wish I could rent my house for $4 a square foot.
Yeah, no, but again, for your investors and buying older stock like that, it's
Mm-hmm.
almost a natural to get the lift,
Mm-hmm.
right?
Mm-hmm.
Because a lot of the newer stuff, what can you really do to it other than paint it,
Mm-hmm. Mm-hmm.
right? So
Yeah.
yeah, very no, that's great. Um, so just going back to other investors, or actually let's keep on going with carbon. So you're doing a lot of podcasts right now. What would you say the number one thing that you're trying to bring awareness, and why you're doing this actually? Are you trying to get
I
investors? Are you trying to just
yeah.
yeah.
Well, I think, it's a good way of getting, our message out in a relatively, it's active, but it's not as active as maybe trying to do some of the, all the social media efforts and things like that. So I like the podcast format. I get to, I like, you never know what questions people are going to ask. So I think it's interesting. It's a great opportunity for people to spend an hour with me, even if they can't spend an hour with me necessarily, and kind of get
Hmm.
inside of my head or get inside of our investment thesis. I'm not raising capital for anything specifically. We are vertically integrated. And I think one of the benefits of that is that we have a lot of control and we're able to really affect change at our properties in a way I think that you can't when you're using a fee only manager. No insult. I know you do fee management, but I think there is some principal agent problems with fee management relative to vertical integration.
100%. Right,
And
yeah.
so, but one of the negatives of vertical integration is that if you really want to get the benefits of it, you really need to think about where you're acquiring property. So when I was third party managed, I could buy anywhere. Basically, like as I could opportunistically buy 1,000 miles over here, 1,000 miles over here. But then once you actually vertically integrate and you say, well, why did I do that? Well, I did that so I could share resources. So I could have one maintenance supervisor across 4 properties and just have my techs roam based on the work order volume, right? I can generate a lot of lift on expense management by doing that sort of a thing, but not if my properties are 1,000 miles away from each other. And so what that requires from us is we have to be very selective in where we acquire deals. One, we have this mandate to be in the best schools, so we're already limited to the 10%, and then we have to create concentration in the areas that we operate in to get the scale benefit and the efficiency benefit. Until we're about at 700 units or so within 2 hours, it's very difficult for me to get down to the efficiency curve where I feel like I'm maximizing that efficiency. And there's some kinks in the along the way, depending on the number of units exactly and what I need at the site level. But somewhere around 500 to 1,000 units in a similar area, I can get a lot better scale and perform. Usually, don't quote me on this per se, but $500 to $1,500 a unit a year in lower expenses versus if I was scattered site single asset.
Well, and I mean, I'm in the property management third party space, and I'm the first to admit it is like the Wild West out there. And so I think that's why a lot of larger firms are choosing to vertically integrate, because they can control those costs. But it's not about the cost. Mm-hmm. It's about the quality of management, right? Mm-hmm. There's an extremely high burnout rate in property management, especially third-party fee-based. And the last time I checked, the North American average labor efficiency ratios were about 67%. That means 67 cents of every dollar that you earn as a property manager is going out to direct property management labor, like office staff. We're not talking about subcontractors or maintenance. Office staff is crazy. So I have some clients where we actually have some products where our company will actually go in and integrate our software stack. And I feel like, 100 to 150 units is kind of that sweet spot where it doesn't make sense to pay for a third-party manager anymore. You can usually do with one property manager or pseudo caretaker, but usually a property manager and assistant. And all of a sudden you're saving $100K per year just on the management fees. Is that what you guys are sort of seeing too?
Yeah, I think that's right. I mean, it's not everything always works so far as like you try to create that efficiency by not having a third party. I mean, in our case, it's a little bit different now, but there are some benefits to having a third party property manager because they've got the Rolodex. They know the people in the market. They know how to get better pricing in some cases. But what we found where we're really saving is one, in the customer experience or client experience, right? We do our own recruiting. So I think that's the biggest, and you spoke to this, like the biggest thing at the end of the day in property management is the people. As much as we use technology and AI and all the different things, and we do our best with all of that, at the end of the day, you need people doing work at the properties, and you need people to handle new potential prospects as well as residents. And so, I find that the biggest lift from our bringing things in house from the third party was proactive recruiting. So we found that when we were doing third party, recruiting was always an afterthought, and it was always after a vacancy. So if someone left, then we were going to start looking to hire someone. And so now this position's empty for 45 days. By that point, we're behind on occupancy. Yeah. And now we're spending 6 months trying to catch up before we get pricing power again. And then everyone wonders why we didn't perform. And so if I look at a deal and I say this deal isn't performing, well, show me the staff. Like, are we fully staffed? Do we have the right people in the right seats? And if those things are true and I'm still not where I want to be, probably because the owner's not spending the money they have to spend in order to keep the property in good shape. But 9 times out of 10, it's because it's the wrong people or there's just missing people from those seats. And you don't have a leasing. No, you have no leasing agent. Well, that's why your occupancy down. You have no property manager. That's why your collections are down. Your leaks are coming from the roof. Well, you have no maintenance supervisor. So it all goes back to those people, the proactive nature of recruitment. And so that's one. The second thing that we found was there was always a little bit of a kind of a black box on how did we get leases? How do we get new people to lease apartments at our property when I was third party? And there was a marketing company that they contracted to do the work,
yeah,
right?
It's terrible.
And once we brought that in-house, not only do we save money there, but we can basically control our occupancy. It's not that hard. We spend $700 and we get a person to live in our apartment, right? It's money out, leases in.
Yeah,
and
you can track every metric.
It's very, you can, once you know the metrics and then you can drive the performance. And so those two things together are really, I think, obviously there's more to it, but those are some big ones that really helped and changed a lot as it relates to how our assets perform.
Yeah, one of my other companies, going big time into it, like everybody is an AI implementation company. And that started out because of this people problem that I had in my own property management company. And so let's spend a couple of minutes on that. Have you seen, just to continue my thought there, we are in almost May right now, right? So up here in Canada, as with everything, our busy season's just about to start, which means I have to hire. I usually use like university students out of school for my showing agents, just because our output of stock, people renewing, the amount of applications that we have every, the showing appointments, because we're single family, so we can't have a caretaker that's just opening doors. We actually have to have somebody drive to a property. That's like tenfold more than it would be 6 months prior in January when it's like -40 here. And so with 10 times more showings means 10 times more applications. So one of the first AI apps that my company built for my management company was an AI agentic agent that could actually, process all of the applications, which has now freed up the A player that I had that was just doing all of this routine work. So for people out there saying, oh, AI is going to have all these people lose their jobs, I don't think so. I mean, it's allowing my A players to do better work and, doing research on the different ILS, the internet listing platforms, and where we can actually get more reach and things like that, as opposed to just trying to pound through these applications. Have you seen anything in AI that's helped your companies?
Yeah, there's a ton of stuff that we've been doing across pretty much every surface area of the business. I would say that there are opportunities, as I said, to reduce costs at the site level for sure. And that does lead to net less heads. But it's not as dramatic as maybe people would think, because you still, especially on the maintenance side, there's not much you can do there.
No.
AI, I can dispatch in a better way. I can be more efficient. I can organize labor based on geography, and that can help. So you don't have to have a supervisor at every single property. You could have one supervisor over multiple properties. And that's really enabled through technology, but not like AI. You do need technology in order to make that happen, but it doesn't have to be anything like cutting edge. But that's a big savings when you can use like more of a hub model. Other than that, we're using it across leasing. So from initial lead in all the way to move in, a lot of our tours, our application processing, all that entire flow is assisted by or handled completely by AI. Now, there's still judgment that we obviously want to retain as a human company. But if we're talking about a lead that comes in at 10 o'clock at night, an AI can interact with that person, provide that information, set up that tour, confirm it, and then let a person know, hey, give this person a call tomorrow morning because they had a question about their dog and we weren't able to answer that question for some reason. It's not in the knowledge base. And so that is something, especially in the front end leasing. But it goes beyond that. Where we found two other places where we find a lot of benefit: renewals, renewal outreach,
Hmm.
and collections. So just the ability to hound people and remind them to pay their rent, and that helps a lot. And that gets we collect millions and millions of dollars of rent right through AI, right? And renewals are critical to us. We as early as we can secure a renewal, the better, right? That means we're not scrambling to fill a unit, or at least we know what our exposure is, and we don't have to let a unit sit vacant 90 days forward. So we incentivize all our people, whether it's AI assisted or people alone, to do renewals at least 90 days out. And we will give them higher bonuses, the earlier they do it. So they can make 3 times as much of the bonus that they would make on day 95 as they would 30 days before expiration. And so that's really an incentive. And that happens because we have surveys that go out automatically via AI to ask questions at 30 days into the lease, 6 months into the lease, after every single interaction, every single work order, 120 days before expiration, 90 days, 30 days before move out. And so we get a lot of feedback from our people, and then we are very proactive about trying to secure renewals, and that's something that is one of the 5 or 6 core data points that we look at. That's in the player dashboard, essentially, that we have in every single site. We have a TV up with the goals for the month, and renewals is one of those very important
Nice.
metrics. So
Yeah, no, it's clearly you're a numbers guy. We talk about AI not being able to replace people. Obviously, home services and trades, that's obvious. But I have always maintained that real estate is a people business. Investors, tenants, whatever you call it, it's all based
mhm.
on relationships, communication, and trust. And that your website, like we're talking about carbon, like communication and trust is really one thing that you guys, I would almost say, is your core mission.
Mhm.
What do you feel that you show your investors that perhaps other firms don't?
I think most folks that are out here doing this work, especially in workforce housing, are in it to, provide great housing for Americans, or for people who live in America, I should say. And as a Canadian, I guess it's like different too, but
It's
basically,
fine. It's all
you know what I
good.
mean.
I'm
Provide
agnostic. It's
housing
it's
for
completely
people,
fine. Yeah. Yeah.
whatever type of people they are, and but I think maybe some of the things that I think we do exceptionally well include, how we take care of if we take care of our people, they'll take care of our residents. And so that really
Mm.
is the name of the game. Now we can buy right, and we can finance it right, and we can be conservative, and we can do the best we can do on underwriting. But ultimately, a lot of the money is made in the ops, and I think that people miss that, especially when people, as a finance person, I think a lot of people who come at it from the finance perspective miss the fact that this is not necessarily a financial instrument. This is an operating business that happens to trade as a financial instrument,
Mm.
which is to
I
our
like that.
benefit. Because we can operate usually at about 400 basis points of NOI better than our fee only contemporaries, because of all of the efficiencies that we create, and all the alignment of interests between our site staff and our teams, and just the investment. So and that's a big deal, and it's a big downside protection mechanism. If you can pick up another 4 points on the cash on cash each year for 10
Hmm.
years, that's another half a turn basically of return, which is a big deal. And it means that you can essentially, not that you'd want to do this, but you could lose half of your initial equity investment in value, and still break even, because we were able
Wow.
to recover that through cash flow. And so that's been extremely valuable during this time when other people are struggling to keep their properties. We've been able to maintain and all of our properties, and we haven't ever lost an investor dollar. And I attribute that a lot to not only how we buy, but more importantly, how we operate and how we maximize performance.
As you're saying that, those who are just listening to this on Spotify or Apple Podcasts, or can't see me smiling. But when you were talking about your identity, it's funny because one thing I say about our property management firm is that we're actually not a property management company. We're actually a technology and IT AI firm that happens to do property management.
Mm-hmm.
And I think if you're as efficient as possible and you're allowing your people to focus on the relationships with your client and provide that customer experience, I mean, it's almost like you can't fail,
Mm-hmm.
right?
Mm-hmm.
Final question, and I ask every guest this, interested to see what you have to say, Michael. So this is the Investing to Win podcast. How do you define success and what does winning look like for you?
As it relates to
Personally, yeah, it doesn't have to be professionally.
well, I would say
I ask that question of every single person,
okay.
so I get all sorts of different answers.
Yeah, I would say success for me is you can see one of my rugrats here on the back here, but I've got 4 children, married, and success to me is I live a fulfilling life. My children, I'm 100 years old. I'm still walking around. I'm at my birthday. All my kids are there. All their kids are there. Everyone's talking to each other. So it means I did something right. That to me seems like a life well lived. And if I can provide, for my children and their children through the business efforts that I do, then that's great. But I would say that's the thing that keeps me going every day and every decade is to support my family and to do right by them and, hopefully, continue to have really good relationships with them and their kids and, stay healthy. So.
Yeah, well said. I mean, as entrepreneurs, why are we working so hard for the people that we're working so hard for if we don't have the time to spend it with them,
Mm-hmm.
right? So that was great. Well, thanks for hanging out with me for the last hour.
Mm-hmm.
This has been really insightful. Like I said, I love having real estate on because it's near and dear to my heart.
Absolutely.
So I will put all the contact information into our show notes so people can reach out to you for more info if they need to. But for now, thanks for coming on the podcast today.
Thanks, Garrett. I appreciate the time.
All right. Thank you.